Welcome everyone. I appreciate you joining me today or watching the recording if you do that. We're going to walk through what a reverse mortgage is, how it works, and why so many homeowners use it as part of their retirement strategy. If you're 62 or older or thinking about cash flow, long-term planning, or simply making the most of the home you've invested in, this session will help give you a clear understanding of your options. My goal is to explain the program in plain language so you can decide whether it fits your situation. Please note this presentation is for educational purposes only. It is not from HUD or FHA and it has not been approved by any government agency. So here's a quick look at what we'll cover today. We'll start with the basics of what a reverse mortgage is. Then we'll walk through some common myths versus facts. After that, we'll talk about how funds can be accessed, how repayment works, the different reverse mortgage options available today, and finally, how some homeowners use reverse mortgages as part of their retirement planning. So, what is a reverse mortgage? A reverse mortgage is simply a loan designed for retirees. It allows homeowners to convert or leverage a portion of the equity they built in their home. It offers flexible repayment options and it includes insurance protections, which is why it's considered a non recourse loan. A reverse mortgage is still a real mortgage loan with a lien on the property. The borrower maintains home ownership. It can be used to purchase a home or refinance an existing mortgage. There is no prepayment penalty, and the home can be sold or refinanced at any time. If I am going too fast or if you have questions, please drop them in the chat. I'll be happy to answer as I'm going along. Most of the stuff should be covered throughout the presentation, but don't hesitate to ask the questions. So what are the key differences between traditional mortgage and reverse mortgage? With a traditional mortgage, there's typically a minimum FICO score requirement. It is a recourse loan, which means you could end up owing more than the home is worth. It does require a monthly payment, and there's a fixed term. Now, with a reverse mortgage, there's no minimum FICO score. It's a non-recourse loan, so you'll never owe more than the home's value when the loan is repaid. There's no required monthly principal and interest payment, and there's no set term. Now, borrowers are still responsible for property taxes, insurance, and any HOA fees, if any, and maintaining the home on a reverse mortgage. So let's look at some myths. First common myth is that a reverse mortgage puts homeownership in jeopardy. What's actually true is borrowers keep title and can live in the home as long as loan requirements are met. A second myth is that borrowers aren't allowed to make payments. Payments are optional and can be made at any time to preserve equity. A third myth is that heirs are responsible for the debt. The truth is that it is a non-recourse loan, so no one owes more than the home is worth. Another common belief is that reverse mortgages only as that oh sorry. Another common belief is that reverse mortgages are only a last resort. In some practices, some homeowners use them as part of intentional retirement planning. And finally, there's a myth that homes can't be sold or refinanced. But the truth is, the home can be sold at any time and be refinanced under certain situations. Reverse mortgage proceeds are determined by a few main factors: the age of the youngest borrower or eligible spouse, the appraised value of the home, the current interest rate at time of closing, and the type of reverse mortgage product. Once we know what someone qualifies for, the first step is to take out any mandatory obligations. That usually means paying off existing mortgages or liens on the property, covering closing costs and loan fees, and paying any required items like property taxes, flood, or homeowners insurance payments if needed. After that, any remaining proceeds, if the product allows it, can be available as a lump sum, monthly disbursement, a line of credit, or a combination. Just like with any mortgage, a reverse mortgage comes with responsibilities. The loan becomes due if the homeowners sell the home, no longer occupies it as their primary residence, does not meet the terms of the mortgage, like maintaining the property or paying property taxes and insurance, or when the last surviving borrower has passed away. When a reverse mortgage becomes due and payable, the loan balance, including any incurred interest, must be repaid. That usually happens through the sale of the home, but the family also has the option to keep the home by paying off the loan balance. And because, again, this is a non recourse loan, the borrower or their heirs will never have to repay more than the home's market value at the time of repayment. If there's any remaining equity after the loan is paid off, it goes to the borrower, their heirs, or the estate. There are several consumer safeguards built into reverse mortgages. First, counseling is required. Borrowers must complete third party counseling so they understand their options and feel comfortable with the decision they're making. There are no prepayment penalties, so the loan can be paid down or paid off at any time without any additional cost. Because this is a non recourse loan, borrowers are protected from owing more than the home is worth at the time the loan becomes due. And in some cases, even when it's not required, borrowers can choose an option that helps cover property taxes and insurance, so there's less risk of missing those payments. So let's take a look at some of reverse mortgage products and examples. FHA HECM adjustable. This is probably the most common type of reverse mortgage and the one that most people think of first. It can be used to purchase a home or refinance an existing one. With this option, loan proceeds can be accessed in different ways: as a line of credit, a lump sum, monthly income, or a combination. And one unique feature is that any unused line of credit can grow over time, which makes this option popular for long term planning. There's no minimum credit score requirement, and at least one borrower must be age 62 and older. The second one is the FHA HECM fixed. It's very similar to the other FHA, but it works a little differently. With the fixed rate HECM, all available funds are distributed at closing as a lump sum. So there's no line of credit options on this one. The interest rate is fixed for the life of the loan. This option is used often when someone is paying off a larger existing mortgage or has immediate needs for funds. So this is an example of a proprietary loan. It's a non-FHA reverse mortgage. These are private programs designed for situations where FHA options may not be the best fit, often for higher value homes. They typically offer higher loan limits, no mortgage insurance, may allow for younger minimum ages, and can have a minimum credit score requirement. Funds are usually distributed as a lump sum at closing, with age requirements varying by program and state. So initial eligibility requirements, let's compare FHA versus a non-FHA reverse mortgage. For proprietary options, borrowers must be at least 55, live in the home as their primary residence. They must meet minimum credit and financial assessment requirements and complete counseling. For FHA HECM loans, the borrower must be at least 62 or older. The home must be a primary residence. We only have a financial assessment is required, and counseling is mandatory. So in this example, we have a 72-year-old borrower. His home is $500,000 in value, and he only has $75,000 left on his current mortgage. With a HECM line of credit, an FHA HECM line of credit, after paying off mandatory obligations, so mortgage lien and closing costs, he would have about $98,000 in a line of credit. After 10 years, if he made no payments to that loan balance and did not draw any additional funds for the line of credit, it would grow to over $202,000. So that's another almost $104,000 added to the line of credit just for letting it sit. So if we take another example with a non-proprietary loan, a proprietary loan, I apologize. We have the same 72-year-old borrower, but in this case, his home value is $1.5 million, which is over the FHA max limit. His mortgage is still $75,000 remaining. With a proprietary mortgage, after paying off the existing mortgage and closing costs, the borrower would receive approximately $514,000 in available cash. and that's a one-time payment. There's no line of credit since it's a proprietary loan. So how does reverse mortgage help with retirement planning? When people talk about retirement, these are the goals that often come up: financial security, reliable cash flow, a healthy investment portfolio, being prepared for long term care needs, having the ability to purchase a second home, and most importantly, having the freedom to actually enjoy retirement. Everything we're talking about today really ties back to those goals. A reverse mortgage can be one way to help reach those goals. It allows homeowners to use their home equity as part of a broader financial plan. It offers different options to help retirement assets last longer and can provide flexibility and peace of mind, especially in unpredictable markets. People use reverse mortgages in different ways depending on their situation. Some use it to solve an immediate need, for example, covering living expenses or unexpected medical costs. Others use it to fulfill a want, like travel, home improvement, or planned cash needs. And some use a reverse mortgage as part of a longer term plan, as a backstop in retirement, a growing line of credit, or a way to preserve other retirement assets. To wrap this up, here are the main takeaways. A reverse mortgage eliminates required monthly mortgage payments as long as property taxes, insurance, HOA fees, and home maintenance are kept up. Borrowers stay in their home and remain on title. It's a non recourse loan, which means you'll never owe more than the home is worth at the time the loan is repaid. And it can provide access to cash through a lump sum, recurring payments, or a line of credit, which can be used to create flexibility in retirement. I appreciate you taking the time to watch, whether you're joined live or just watching the replay. If this helped clarify how reverse mortgages work, that was the goal. I'll stay on for a few minutes if there's any questions you'd like to ask in the chat. If you'd like to talk through situations, your situation, or help a family member understand their options, I'm always happy to have a simple conversation. Thanks again, and I appreciate you being here.